Welcome to Xcelerate with Shawn Redford. The Xcelerate Xcast is designed to provide exterior agents with simple, repeatable, and profitable strategies for you to grow your business. We will share ideas on how to identify ideal target markets and new opportunities, improve your conversations with proven scripts and storytelling, and finally, we'll also meet with industry experts and our partner companies to ensure we're up to date with the newest technology and insights, all so you're able to accelerate your growth. We hope you enjoy Xcelerate with me, your host, Shawn Redford. Today we'll be speaking with Vanessa Scott, National Living Benefits Consultant with Manulife Financial. They say your health is your wealth, and Vanessa believes that. Today we will be talking about Synergy, a unique product from Manulife that incorporates life, critical illness, and disability insurance all in one. And who better to talk to about it than Vanessa Scott? Her passion is to take her practical and technical expertise and translate this into effective and workable sales strategies that are easy to digest. She specializes in taking the sting out of having living benefit conversations. She's well known for sharing her unique yet simple, effective sales language and ideas. She believes we can have these important discussions with clients without confusing them or ourselves. So let's have a conversation with Vanessa. Thank you so much for joining me today, Vanessa. I'm really excited about this opportunity to talk about, to help our agents figure out how to position critical illness insurance, disability insurance, and how your product offering fits compared to the competition. So I really do appreciate you taking the time today.
Thanks for having me. It's a pleasure.
So let's get things kicked off. I think, what's probably hardest when it comes to insuring people for living benefits is determining what's the need. How much coverage do I need? It's not as simple as life insurance calculation. So how do you direct advisors as to determining what the need is for CI and DI?
For disability, I think it's a little bit easier. And we'll start there only because I would start with the budget. So most clients, some clients, not everyone, has a sense of what they need every month to make their life run. So I would start there because I think sometimes when we talk about all insurances, whether it is life, CI, or DI, we can sort of get into sort of a mortgage comparison. So what I mean there is if you go to a bank and you say, this is how much money I make, the bank says, well, this is the biggest house you can buy. This is the biggest mortgage that we're comfortable with. Now, the problem is when you get that biggest number, sometimes that's not the house. That's not the payment every month that you want to live in. So I always start with what do you need? What's important to you? So we start with the budget, and more often than not, that starts the conversation about what the disability number is. With critical illness, it is a little bit different. Of course, it does come down to, if this were to occur, what would you like to happen? And the problem, I think, with critical illness is we don't know necessarily what we might be afflicted or diagnosed with. So I like to use an acronym, and I know living benefits is horrible because we have all of these extra acronyms, but a great little piece that instead of doing a comprehensive needs analysis, which can spit out a really big, frightening, sometimes pricey number for a client, I like to go back to an acronym, and it's CIDA, C-I-D-A. So the first one is cash flow. So what is your largest cash flow item? And for a lot of people, that's rent or mortgage. And would you like Manulife to cover that for 1 year or 2 years? Now, what I really like about that approach is you're going to get a weird number. You're not going to get $100,000. It's going to be personalized. So a client sort of has that attachment. They know where that dollar comes from. Or you can look at income. What is 60% of the family income? And now 60% is roughly the amount that after government taxes and different things, we get to keep. So again, would you like us to cover the family income? And again, family, because a 2-income family doesn't save 1 income, they live off 2. Would you like us to cover that for 1 year or 2 years? Or debt. Is there a debt item that you would like us to retire for you? When critical illness was first launched in the industry, we always talked about retiring the mortgage. Again, that sometimes is too big of a number for clients because critical illness is a story of recovery, right? More often than not, it's not going to be needing to pay off the entire mortgage, but it might be some pesky line of credit, a credit card, student loan, whatever the case might be. And then the last one is affordability. I think sometimes the mistake we make as an industry, as advisors chatting with our clients, is we like the idea of someone having permanent coverage. So when we talk about affordability, you find the number and then you show your client different options. Maybe we rent for a little bit in term, 10 or 20. Maybe we're looking at something that just gets us to recover retirement, like 65 or 75. Permanent coverage 100 is always on the table as well. But once we get the number, then let's find which one is most affordable. So I use the acronym CIDA, CIDA, cash flow, income, debt, and then talk about what duration makes the most sense.
I love it. That's great. And, one of the other things that you just mentioned there, which I've always thought, especially, I mean, over the last 20 years, I've learned how not to sell critical illness insurance specifically. I think, when we all started, hearing about the product, it was all about, hey, you're going to take this money and you're going to jump the line and you're going to go to the US for your treatment because Canada doesn't offer good enough, fast enough treatment, which I think many of us can say, no, that's not actually true. And I think if you focus on that, you're giving an opportunity for the client to object if they've had a good positive experience in their lives with healthcare in Canada, right? But you did highlight something, the story of recovery. And I think that really is the key when I'm differentiating disability insurance from critical illness insurance. CI is about getting you well, getting you back on your feet to the lifestyle that, well, hopefully the best lifestyle you can have after suffering from a life-threatening illness, right? Which is what critical illness insurance is. And that's why I often like to start the conversation when talking about critical illness insurance about its history and how Dr. Marius Barnard created it, why it was created, and the benefits to the consumer. And I don't want to monopolize our conversation today about critical illness insurance. We're going to have a whole other session on that.
Yeah.
But how do you open up the conversation about critical illness insurance? We'll start with that, but then also disability insurance.
And I love the story of Dr. Morris Bernard as well. And as your team might know, he's unfortunately left the planet. The easiest way to tell his story, though, is to go onto YouTube. And you can share his words from YouTube with your client. And I like to do that in advance of a meeting because we've all watched a YouTube video. You don't have to be a technical expert, but there's a 4-minute video where Dr. Morris Bernard tells your clients and also gives us a refresher too, if we need it, why he created it, how he created it, and more importantly, why everyone needs some. So when you talk about, using technology to give us a lift or do a little bit of the heavy lifting, that's a great opportunity to do some of the education for our client. The other education piece or technology piece is I like to go onto a public website. Now it is sponsored by Manulife. It's called insureright.ca. And what you can do there is in a 1-minute survey. And really all your client needs to do, and you can do it in advance or you can do it with a client, they need to know their gender, their age, and their smoking status. And with those 3 little items, you will actually show their personalized risk of what is their risk of a critical illness, a disability, or a life insurance event, death, happening between now and age 65. And then the other thing that it does is it shows the cumulative risk of one or more of those things happening. And what I really like about that is a lot of our stats, unfortunately, in this industry talk about a male 40 non-smoker. And if you have that magical client, then all the stats you see will resonate. But you also have 32-year-old female smokers. And they'll look at a male 40 non-smoker and go, that's not me. And it's really easy for a client to disconnect. So I like to show those stats. And by the way, those stats are all pulled from external. They're not Manulife baked up stats. They're the Cancer Society, Heart and Stroke. And all of a sudden, when you talk about the reality of these things could happen, it makes a client sort of pause a little bit. And it's hard to ignore some of those numbers.
Mm-hmm.
And when I think about insurance in general, and whether it is life insurance, critical illness, disability, long-term care, you name it, I like to think of insurance as seatbelts. Right? We put seatbelts on not because we think that today's the day, right? That we're going to make a mistake when we're not paying attention, or the vehicle's going to fail, or the sun's going to be in our eyes, or the snow eventually will be involved, or someone else will inflict their will upon our day. But we put seatbelts on just in case. And we've got a lot of clients out there who are moving around Canada without any seatbelts on. So whether they think they're at risk or externally they could be at risk, we need to make sure they've got at least some protection. So it's a great way of, I ask clients all the time, did you put your seatbelt on today? And they go,
Great.
yes. And I'm like, so ask the question why. Now you will get sometimes the smart answer of it's the law and I have to. So, or my car will make that horrible dinging noise, so I have to comply. But once you get past that, it's really because it's just in case. It's a safety
Yeah.
feature.
Yeah.
So it's the same thing when you talk about insurance in general.
Yeah, and to that point, I just pulled up, based on your example there, a female 32. I put non-smoker. I think you might have said smoker, but I put
Yeah.
in non-smoker. And I love how the website illustrates the various needs. So basically, it says disability, or rather, the likelihood of a disability before the age of 65 for a female 32 non-smoker is 27%. So 27% chance that that could happen before age 65. Critical illness need would be 19%, and the likelihood of dying before age 65 is 5%. And so before we get into the last number, which you and I both know is
Mhm.
coming, but those three individual probabilities, when asking the client, which one should we insure?
Mhm.
It really changes the conversation because, death is final. That's it, right? And though there's only a 5% chance, there's no ability to recover from that, or for your family to recover from that. Um, and this is often what people think, but critical illness, a 19% chance, so significantly higher chance of a critical illness,
Mhm.
we often assume that we're going to be okay, and that we will be able to recover, and that we'll be able to earn income at the same level as we did prior to that illness. That's certainly not the case. And that's a big reason why we want to have this protection in place, is because we don't know what the future is going to hold after that period of time. And anyway, so when you put those three risks together, the chance of a disability, critical illness, or dying before the age of 65, statistically, we don't know which one of those three things is going to happen to us. In exclusivity, we do know the probabilities, but combined together, there's a 40% chance that one of these three things is going to happen, a 4 out of 10 chance. That's a high probability. And I'm not a big proponent for selling on statistics because they can be manipulated, right? I think there's a better way to position these needs, but it is still quite a telling statistic that a 4 out of 10 chance that something's going to happen to you. And if you were to have a couple and go through this exercise with a couple, the likelihood of one of the two of you having one of these three things happen is even greater. We're talking 60, 70% chance of it happening. So, it really does help the conversation. And I love your point. Get the client engaged, get them to do
Mhm.
some work in advance of the meeting, get them to buy in and becoming empowered and educated themselves. Send them the Marius Barnard YouTube video. Send them a link to this website so that they can play around with it and do a little bit of their own research, because I think there's so much misinformation on the internet. And even Chat GPT, it's gathering
Yes.
information from the internet, but you don't know what the sources are. So I think it's really important for our advisors to control the narrative and put the resources in front of our clients that we believe in, that fits our values and our philosophies. Would you agree?
Totally. And I will even add one thing, that when you show numbers like that to a client, you will have clients who say, yeah, okay, that's the average Canadian, and I'm healthier than the average. So this is, so what I usually say is, okay, I love that you're healthy. The fact that you're healthy actually allows you access to these kind of solutions. But because you're healthy, do you think it takes your numbers down to zero?
Hmm.
Or maybe we shave 5 points, which is still good, but these risks are still significant. And by all means, we're not saying life insurance isn't an important part of planning. Absolutely, it is. But in the short to medium term, between now and 65, for a lot of clients, our doctors are really good at making sure we don't use our life insurance, which is why living benefits exists, right? Their whole goal is to make sure that you survive whatever is going on in your world, which opens up the
Exactly.
conversation.
That's great. So tell me about the Synergy product. What makes it unique in the marketplace? Why should our clients be considering it? And more importantly, who's it the right client for?
Sure. So the first thing I would say is Synergy does have a focus market. So it's anyone under 50, 50 and under. So that's the first thing I would say. But Synergy is it was designed because we recognize that Canadians don't have all these solutions. It can be somewhat overwhelming. And for some, it's a fearful budget item. They can't afford all the various pieces that we want. So, like your phone bill, we bundled something that's very familiar to Canadians. So, what we did is we put life insurance, critical illness, and disability policy all in one because we heard from some clients, I don't like multiple packs coming out of my bank account. So, there's only one. And it's one conversation now. It's let's address the risk for you and your family in one policy. Very similar to like our home and cable and internet. When you have those three, you might have something in your home and you go like, I really love my TV and I love my internet. I've got a phone. I don't really use it. It's not as valuable, but I'm not comfortable not having it. So again, we might have clients who like certain components, but by bundling it together, we were able to pass on savings. So on average, when you bundle it as compared to separate, you're looking anywhere from at younger ages, a 25% savings, at older ages, a 5% savings. But clients like the idea, and what we hear from advisors as well, is it's nice to be able to have one conversation, not go back and forth to the same household over and over and over, and also risk of which one do we do first and do we get to them all? And again, we get client fatigue, we get advisor fatigue too.
Yeah. So affordability, I think, is key, especially in tough economic times when we're trying to stretch the dollar as much as we can. Because I think we would both agree, buying 3 individual products, you might be able to get a better offering in each one of those categories. But by bundling it all together, getting that cost savings and just the peace of mind that, as you said, it's one and done. You've got one conversation, one payment coming out of the bank account, one application process for the client to jump through the hoops for and have some stranger come in and take their blood and all these wonderful things, very, very intrusive things that you have to go through to get insurance. I think it makes it easier and certainly much more affordable. So one thing I do recall learning about this product is as it pertains to disability insurance, it sometimes is going to be more favorable for a client taking this product than looking at other types of products. Can you explain that?
Absolutely. But just before I do so, one of the things I do want to mention that is really nice for clients is we actually don't poke and prod them. So there are no what we call biometrics. There's no blood, there's no urine on this no parameds on this kind of plan. So then the interesting thing about the synergy plan, because we've bundled it, and it's true, you lose the ability to sort of manipulate the plan because it's pre-bundled. But when we pre-bundled it, we also had to say, well, what kind of occupational risk are we going to call all of our clients? So there's no occupation classes. So if you ever looked at disability before and you had to figure out what class someone figured out, you don't have to do that with Synergy. We call everyone a middle of the pack risk, which is a 2A risk. So that means if you have a client who is a little bit more blue collar, right, a little more dirty hands at the end of the day, a little higher risk because of their occupation, they're actually getting the perk of a 2A or a middle of the pack risk. So what we sometimes find is for those clients who, let's say a paramedic, right, who is a higher risk by their very nature of their job, they're actually getting rates that are roughly 50% cheaper than that they could get in the open market. So if you look at Synergy, right, the DICI life insurance, and you look at a plan outside that just offers disability, what you'll find is typically the 3-in-1, it's actually going to be a lower monthly obligation than just the disability. So in a world where everybody is looking at their budget, regardless of income, clients like the fact that they have that built-in savings. It's almost like getting the critical illness and life insurance for free, but it's really just the pricing model behind the scenes.
Right. So, I mean, the average consumer might be saving 5 to 25%, but certain occupation classes that would be considered higher risk can be getting a substantially greater savings. So, an example, and I love to share examples because I want our agents to be able to identify the clients or their prospects in their business that are best suited, the easiest low-lying fruit, I like to call it,
Yeah,
right? So, your paramedics, could you give me some other examples of some other
sure.
occupations?
I would say electricians, mechanics. We've even just recently expanded our offering to gig workers, so those people who are driving Ubers and delivery services. Really anyone, and I call them blue or gray collars, but the clients who work hard and have dirty hands at the end of the day are typically that B risk or even an A risk.
Right.
So again, skilled workers, anyone, again, in that blue gray world has that built-in natural savings.
Truck drivers?
Truck drivers, absolutely, whether they're
Yeah.
long haul or they're local delivery. Um, Daycare workers. Interesting enough, too, we also offer stay-at-home spouses who work but don't only work inside the home. We offer them coverage as well. And that's kind of a unique offering where normally someone who's a stay-at-home parent doesn't have the ability to get real, meaningful disability. They can get sort of accident coverage, but they can't get sickness and accident coverage. And they can get this plan as well.
That's great. Is there a limitation on how much coverage they're eligible for?
So for a non-working spouse, they can get as much coverage, and we cap out at 500,000 as the pool of money for those three solutions, as their working spouse has in life insurance, all sources. So that would include mortgage coverage, coverage at Manulife, coverage at any carrier. So if you have a spouse, a working spouse that has $500,000 worth of life insurance somewhere, somehow, wherever, then the non-working spouse can get the maximum, which is 500,000 as well.
Excellent. And yeah, just to clarify for our audience, the pool of assets is what makes this unique. So when you apply for this coverage, you're applying for $500,000 of coverage. Now, should you pass away, the $500,000 pays out as a death benefit to your estate or your spouse beneficiaries, whomever it happens to be. If you have a critical illness insurance, how does that work?
So for critical illness, and 500,000 is the maximum. We can go as low as 100,000 as well. So it's 25% of whatever pool or account that you've created with Synergy. With disability, now this is where it gets niggly. It's 0.5% of the total pool. So I never explain Synergy this way to clients because we don't want someone to have to do math, right? Neither do we want to do math at a moment. Because if you're doing math on 100,000, it's pretty easy. If you have a client who's buying 325,000, then doing the math can give you a pause.
Exactly.
So I like to instead say for every 100,000 that your client purchases, that's $100,000 worth of death benefit. It's $25,000 worth of critical illness, and it's $500 per month of tax-free disability payments per month. So that's a much easier way for both us and our clients to go, okay, 100,000, 25,000 of critical illness, $500 a month of DI. The life insurance is the total amount. So it's a nice, easy, scalable number for us math-wise.
Our advisors often run up against the objection, I've already got coverage through my lender. You know, I went to the bank, I got my mortgage insurance, and they made me sign this paperwork. And apparently I've also got disability insurance and critical illness insurance as well. How should our advisors address that objection?
The first thing I'm going to suggest is congratulate your client for doing so, right? Because having some coverage is a great starting point. The second thing I would say is, have you ever read it? Because sometimes when we're getting coverage through a lender, it really is designed to protect your lender, right? If something happens to you, you don't get the dollars, but your lender is made whole, which again does serve a purpose of paying the mortgage or covering off the loan payment. The challenge, though, is sometimes there's some fine print in there. We recognize this and we compete with the banks quite well. So just because someone, by the way, has coverage with the bank doesn't mean they have to keep their coverage with the bank. That's the first thing I would say. So we do see clients who replace their bank coverage with Synergy, because what you'll find is that our bundling is more cost effective than what we sometimes see at the banks. Well, more often than not, what you're seeing at the banks. And the other thing is that it doesn't erode. And I don't mean it in a bad way, but if you have something tied to a loan or to a mortgage, as that loan or mortgage is paid off, then the obligation, the coverage is starting to get smaller as well, because that's what the coverage is all designed around. Synergy, because a client owns it and controls it, the dollar amount, the 25%, the $500 per month per 100,000 of disability coverage doesn't change, right? They're the only ones, the client is the only one that can alter that plan and reduce it. So from that point of view, you know, if your mortgage is almost paid off or that line of credit is almost paid off, the coverage that you have at the bank that you've been paying for the same amount every month might actually not have as much oomph or teeth left in it.
Mm-hmm. Yeah. And another one I like to often bring up is what happens when your mortgage renews and you decide, because when it comes to mortgages, especially today with
Mm.
interest rates where they are, you're going to look around, you're going to shop around for the best possible rate. And if you change banks, if you change lenders, you're going to have to requalify for that coverage. You may not requalify for it, and now you're left without that coverage and you're stuck without
Yes.
that option now.
Yeah, absolutely. The other thing that we saw when we designed Synergy is we recognize that sometimes clients have other coverages in place, whether it is through a lender, through an employee benefits plan, through an associate plan, or maybe they bought a small disability plan way back when. And one of the things that I've always worked with advisors, and like, okay, so now I have to figure out the math of based on which they already have, how much more can they have without going over limits, and how do these things work together? And it can be a little bit complex.
Sure.
So what we've done with Synergy is we've made it simple. So the life insurance, the critical illness, and the disability insurance within Synergy pay in addition to whatever else a client already has. So there's no math required. I
Hmm.
sometimes talk about Synergy as the gravy, right? It's just the gravy on top of. Doesn't matter what's underneath, it will pay in addition to.
Yeah.
So you don't ever have to do the math of the client has that $1,000 plan from way back when, they have some group coverage, they have some mortgage coverage. Where's all the math? How do these all work together? You don't have to do that. With Synergy, if the client wants Synergy coverage, the disability policy pays in addition to, the critical illness in addition to, and the life insurance in addition to as well.
Hmm. And it's sad. I mean, I think the stats, we hear it from LIMRA, our profession, our Marketing Research Association, every year. How many Canadians in particular, I'll make this Canadian focus, but I mean, the same goes in the US. How many are underinsured? And when they're talking about that, they're talking about life insurance, how few people actually own life insurance to support their needs. But those numbers are drastically different when you look at disability insurance and critical illness insurance, where a minute part of both populations have enough coverage in place. And so, it's the responsibility, I think, of our agents, of our advisors, to have the conversation, right? Just talk about it. Just open up the conversation. And you set it off the top when we were talking about how do you address the need for coverage. And you said, start with the budget,
Yeah,
right? And I think starting with the budget also starts with understanding your expenses. Like what coverage do we need in order for us to maintain a comfortable lifestyle? And I think with most people, regardless of their affluence, I've seen people who make hundreds of thousands of dollars a year living paycheck to paycheck, just like low income families are. But that's their need. To them, that is their need. So understanding not just how much they can afford, but how much coverage do they need in order for them to maintain a comfortable lifestyle? And it just starts with having that conversation with the clients and getting them to do some of the hard work.
it is. And really I think of insurance, all insurance is a stress remover, right? And especially when we're talking about living benefits, but certainly life insurance as well. But when we think about living benefits, that disability and that critical illness, things are not great at home, right? Like
Mm,
where you're dealing with an injury, a sickness, and you can't go to work. So it's a stressful. I mean, when you're dealing with whatever that physicality is or the mental health issue might be, and you can't go to work. And again, so many of Canadians are paycheck to paycheck or, a couple paychecks away from really being in trouble. So then you have that added stress of, I've got to get better. Or you might be dealing with someone just said some really scary words during a diagnosis, and maybe you don't know exactly what that looks like. So having these kind of coverages in place just gives the client breathing room. It's one less thing that they have to stress on. They're going to be stressing about what's going on with them from their body, from their mental health point of view. This is just one way we can reduce or minimize some of the money stress. And we know that
absolutely.
when someone is under money stress, it actually hurts the body, and it doesn't allow us to recover as quickly as we could. So by having this conversation, not only to being responsible for what we do for a living, but it's also giving clients that breathing room that, this stuff happens. It happens a lot. And we can't stop you from having it. Like we don't have that kind of insurance out there yet, but at least we can minimize some of the stress and the worry for someone who's going through.
Yeah. And I mean, that's one of the key takeaways I got from Dr. Barnard's
Mm-hmm.
rationale for why he created this product was to reduce the stress and allow the patient to focus on their recovery, not have to worry about anything else. And that would expedite, it would certainly help their recovery. And it's often, if you're a single individual, I would argue, especially if you don't have any dependents, disability insurance and critical illness insurance are absolutely important, compared to, say, life insurance, because they allow you to take care of yourself.
Yeah.
But the interesting thing I've always thought about both disability insurance, critical illness insurance, and especially life insurance is that all of them are also for your caregiver or your partner, right?
Yeah.
We always talk about how CI and DI are selfish coverages, right? You're the
Right.
beneficiary, unlike life insurance, where somebody else is actually going to get those proceeds. But in a way, I kind of disagree because both disability insurance and CI also reduce the stress of the entire household. They give that caregiver the opportunity to maybe take an unpaid leave of absence because they don't qualify for disability insurance, but they can afford to take some time off to help you through your recovery or spend more time with the children or do
Mm-hmm.
whatever needs to be done, not only to help you with your recovery, but to help the household maintain whatever semblance of normalcy it can while you're dealing with this scary time in your life, whatever it may be.
It's so true. We see, and I mean, I see a lot of claims, right? And I'm always, where it's appropriate, ask people how are they using those proceeds? Like, what did it do for them? How did they use those dollars? And one of the great stories I often hear is families who are not a nanny type family. So in today's world, they don't have childcare at the house. They don't have a nanny or a housekeeper. And when they're going through a major health issue, they have the dollars available where maybe they do hire someone in. And again, it might be for 6 months or a year. It's not, a lifestyle change. But for that period of time where maybe mom and dad are over here and they're dealing and they want to shelter the kids from what is really going on, the kids still have a clean house and warm meals and go off to soccer and swimming and whatever else. So they can be somewhat oblivious where mom and dad are over here dealing, maybe freaking out, dealing with some difficult moments and having those extra dollars where most of us don't have the ability to just go, well, you know what, I'm going to hire a housekeeper and a nanny for the next 6 months. Or if you did so, you'd have to raid your investments or make, lifestyle changes and sell something. It just gives people breathing room. And when I think about living benefits, it's about breathing room.
Mhm. Absolutely. It reminds me of a story too. And I think this is the benefit that we have today, 20, 30 years after we were introduced to critical illness insurance in the industry, really, is, well, experiences
Mm-hmm.
and understanding how different people choose to use these proceeds in different ways. And that's the beauty of this. These products give the consumer the choice and the flexibility, the independence to decide how am I going to use these proceeds to best benefit me. And another example I had was an advisor down in Windsor was diagnosed with cancer, and he had to go into Toronto for his treatments, and that's a bit of a haul, right? So he and his wife would go in for his chemotherapy treatments, which were several days at a time in Toronto. So she's missing time from work. They're driving up there. They decided to stay at the Ritz because, you know what? I'm going to feel good when I'm feeling bad,
Yeah.
right? And I don't want to have to worry about the money. And the money was
Mm-hmm.
there. The proceeds, thankfully, the critical illness insurance was there to help afford that. If he was willing to eat while going through the therapy, he certainly didn't want to do it in public. So they ordered room service every day, right? It was a short jaunt over to the hospital. So it afforded them an ability to kind of deal with the recovery on their terms, the way they wanted to do it. And I think that's another just great benefit that we didn't realize and appreciate 20 odd years ago, that that's how people would use the money. It really is customized to you and you tailor it to whatever you need it to do for you at that time.
Absolutely. And I think you've hit on a great item. And I know your advisors know this, but it's about telling those stories. And when you have those stories or you share different ways that people have used the proceeds, you don't have to have a client who says, that's the way, or I don't like this one. It's by having multiple stories. We had a gentleman who had a diagnosis. It was going to be a long recovery, but he was going to come through it. And he recognized that it's difficult to sometimes visit someone who's ill, right? You never want to impose, you never want to overstay, but he still wanted to have that social interaction, but he was kind of housebound for a period of time. It was going to be about a year and a half. So what he did was he built a man cave. So a man cave, in case you're not familiar, is like the little, oasis where it's the best chairs, the biggest screens. He had popcorn makers, little fridges for beverages. Um, and what he did was he'd invite his friends over for the game. Now, the game shifted depending on what season it was, but all of a sudden he could have his friends over for 2 or 3 hours. They'd visit, they'd do this, very chill watching of a game. There wasn't a lot of physical interaction, but then it gave his friends the opportunity to come over, visit, and then leave. So he still had that interaction, and they never felt that they were imposing because they were just visiting the friend with the best man cave.
Yeah, and what a male way to support somebody. We don't really want to talk about it. We don't want to share our emotions too much, but you know what? We do want to show that we care and that we support you. So we'll come on over and make it a very comfortable time spent together rather than sitting around somebody's bed looking
Yeah,
at them lying there. No, I think that's a brilliant idea. And yes, I agree totally. Stories are what consumers need to hear because unless they've lived the experience themselves, not necessarily themselves being sick or dealing with the recovery of an illness, but having had a family member or a friend deal with it that they can relate to, that they can appreciate how proceeds could have helped that person, that individual deal with their recovery, whether emotionally or financially. How could it have improved their recovery for them? And that's one of the key questions I like to ask right off the bat is, do you know anybody who's ever suffered from an illness, a disability, or an injury? And then what's often hardest for us advisors to do is just be quiet and listen to them tell the story, right? And not in a bad way. We've had so many experiences, we've had so many conversations, we've helped so many people just like this person or this couple that we're talking to, that we just want to share the solution that we believe to be the right one for them. All good intentions, of course, are there, but they don't know that. They
yeah,
need to be taken through the experience and the understanding and the emotions of what if, and I think that was one of yours, right? That's one of
yeah,
your lines that I'm stealing, Vanessa. What if it happens to me? And the best way to do that is to actually visualize somebody who's actually been through that experience. And if you don't have your own stories, I encourage my advisors to talk to other people, get their stories. Go to the internet. There are countless articles in the Globe and Mail, Toronto Sun, the New York Times that talk about how people have been affected by a critical illness and didn't have the coverage in place, or suffered a disability and lost their home. I mean, the number one reason for mortgage foreclosure in North America is due to a disability, right?
yeah.
So those questions, those conversations, those stories are absolutely critical, I think, to the entire process of understanding where it fits.
Yeah, I talk about the if all the time, and it is true. You ask the difficult question, what if this happens? And you can use that in all areas of financial planning. As you mentioned, the hard part, ask the question and live in that uncomfortable silence for a moment, because we are asking a client to have an uncomfortable thought process. We all like to think that we are invincible, supermen, superwomen, and that nothing ever could knock us down, especially your business owners. And you're asking them to imagine something going wrong. That's where, quite honestly, synergy comes in, because of course we address all of those what ifs in one solution. So you get um, the comment sometimes for a client, well, I can really afford one or the other, disability or critical illness. And I've heard from clients, well, Murphy's Law. I'm going to buy the one and the other one's going to happen to me, right? That's just the way, my luck turns out.
That's my luck. Yeah.
Yeah, exactly. That's where synergy really comes in. And with one conversation, one application, one premium for a client, you are covering all of those ifs.
You bring up another good point there. What about for business owners? Is there any difference with buying Synergy as an individual versus as a business owner? Any pros or cons?
Not really. So you can do it either way. Really, you don't get to automatically write it off if you're a business owner. That's usually the question is, if I do it for my business, can I write everything off? No, CRA doesn't change the tax rules based on ownership, but it does open up a conversation. Some business owners, they look at their personal life and they say, I'm covered in my personal life, but my business has exposures. So we know that in the event of a business owner being disabled or being critically ill or passing away, there might be financial needs within a business. So you can actually put synergy inside a business to protect the business as well. Or you can also get creative. We have sometimes situations where the business needs some life insurance. Maybe it's a buy sell situation with a partner, and the client that you're working with would like the critical illness or the disability insurance personally. So you can actually have, although we put it together as three policies in one, you can actually sort of dismantle them. So you could actually have the company have the life insurance if that's where the need is. And then through showing as a taxable benefit, you can show the disability part still going to your client, or the critical illness part staying in the company or corporation, or going to the client themselves at the house. So you really have some flexibility there as well. Even though we've bundled it together for you, you can dismantle it if you'd like.
So the premium on the illustration is broken apart, so it's easy to compartmentalize each of them.
Absolutely. So your client might see
Perfect.
it's $100 a month, but really that's 40, 40, and 20, right? Critical
Right.
illness, disability, and life insurance. So you do have the ability to allocate the different parts based on what the need is and where the need is too.
Vanessa, you made the comment that it's designed for people under the age of 50. Is there a minimum age for people to qualify for this product or to be interested in this product?
Absolutely. So it is an insurance contract. So they do have to be 18 years or older in order to insure. It's interesting when we first started with the 18, we heard from a number of people, well, 18-year-olds, 22-year-olds aren't going to be interested in this. And actually, we see two markets. One is those people who are just starting out are budget minded. They recognize that if something happened to me, right? Again, we talk about that selfish insurance, or they don't have a life insurance risk at the moment. They don't own a home. They don't have spouses. They don't have kids. So life insurance is a harder notion for them to get across.
Mhm.
But protecting them from what could happen from them for a health point of view really resonates. But also we saw mom and dads. So if you happen to have a client who's older than 50 and they go, I'd love this product, but I can't, then ask them if they have any of those, what I call mini adults. Mini adults are folks who are 18 plus. They're starting to look like adults. They're starting to act like adults, but they're financially fragile. So some of those clients would be very happy to look at a policy that maybe covered all three of those risks for about $70, $80 a month. But some of them would also go, 70 or $80 a month is my weekend money. I'm not parting with that. It's too precious. But mom and dad might be interested in a solution like this for that mini adult, because that keeps that person independent in the case that something happened. So it's kind of protecting the what we call the bank of mom and dad, because we know if something goes wrong with those mini adults, they come knocking, or they come back to the house and they move back into your basement. So it keeps them independent, and it teaches them the lesson that we often hear from clients. So when we have someone who's above 50 for the solution, or someone who's uninsurable because they've had some complex health history,
Mhm.
I always ask a really important question, and this is a great one that your advisors can use. What would you tell your younger self as it pertained to investing and insurance? And you'll hear lots of stories, but it really boils down to two things: younger, more. So there's a great opportunity to say to someone, is there someone in your life that I should be having that conversation with? Starting younger, buying a little more than you thought, because maybe they're not going to listen to mom and dad the same way that they would listen to an insurance professional like your team.
Absolutely. Oh, that is golden. Brilliant. I hope everybody wrote that one down. I'll be highlighting it later for sure. I'm stealing that, Vanessa. I appreciate it. Um,
Absolutely.
you mentioned you're like the bank of mom and dad and mom and dad wanting to protect themselves and the fragility of their child. But I've often said to those individuals, maybe not at 18, but the 25 to 30-year olds who maybe they don't have dependents, but they're just starting out on their own. They're living out on their own, whether they're renting a place or they were fortunate enough to be able to buy their own place. Would you want to have to give all this up and move back
Mhm.
in with mom and dad and be dependent on mom and dad again? That's, is it worth you giving up one weekend of partying,
Yeah.
to your point, you know, pay the 70, $80 a month to ensure, right, to
Hmm.
ensure your independence, to allow you the flexibility of choice and to deal with your own recovery under your terms, under your roof. And I think that as children become young adults and start to become more independent, they appreciate it and they don't want to give that up. So, it's a good investment in their own independence. So thank you.
Absolutely.
That was great. What would you tell your younger self? Love it. Love it. Um, I remember when Synergy was launched, it was a pretty exciting product, namely because of the bundling and the pricing, because, well, the living benefits are expensive when bought separately. And as we have already talked about, it was designed for the blue gray collar workers. Have you found any surprises in that marketing or in any of the marketing initiatives or plans for this product since it's been launched?
Have and this was certainly a light bulb moment for us at Manulife. We actually see about 25 to 30, depending on the year, of our sales not come from the blue gray market at all, which is again where we thought most of our clients would be mid market, because it's again that great bundled solution or blue gray, the dirty hands at the end of the day. But 25 to 30% of our sales every year are for high income earners, executives, clients who are busy. They're too busy to sit and talk about insurance, way too busy. So this is a way of, okay, I have one meeting, one conversation. I can get it all done at once, right? So it fits that A type driver kind of personality. But also because that disability coverage does not integrate, does not reduce, pays in addition. So clients who might be fully insured based on their income and the calculations that the insurance companies have about how much disability coverage you can have, because Synergy sits on top, you can actually get at maximum another $2,500 per month, right? And that's assuming $500,000 worth of synergy. You can
Hmm.
get $2,500 a month on top of, you can actually knowingly overinsure yourself.
Yeah.
And we're fine with it. We've designed the product, we're totally comfortable. But we were surprised how many what we call 3As or 4As professionals, people with letters behind their name, really like this solution. Again, because they get that extra little perk of disability coverage. Because, as to your point, sometimes those higher income clients, they are more overextended or extended than sometimes our clients who are living more modest, normal, middle class lives.
Yes, yes. And the budget is just as important to them as it is to the lower income families. I totally agree. I've I've seen, doesn't matter how much people make, they still find a way to spend every dollar that comes into that bank account every month.
Yeah. And then some on occasion.
Yeah, yes.
Yeah.
Um, when it comes to especially living benefits, we often hear that there are certain limitations or exclusions to these products. Are there any that we should know about when it comes to synergy?
Absolutely. So because we did bundle the plan, we did have to, and we make the underwriting process very easy. So, for example, we don't ask any disability questions whatsoever. There has been a little bit of a give and take. So, there's a couple of things that your client, your advisor should be aware of. The first one is in order to have a disability policy payout, the client does have to be in North America, both to start the waiting period, which is 90 days, or to receive the benefit. So if they are overseas and something happens, they're covered, but they do have to come back to North America, Canada, or the US in order to start the clock for those 90 days, and they have to remain in Canada or the US in order to receive the payments. Because the disability doesn't ask any questions, we do have to protect Manulife a little bit. So there is what we call a pre existing condition clause. So if you've had something 24 months before, and you didn't tell us about it, and that's an important part. You didn't tell us about whatever happened 24 months before you bought the policy. You're not covered for that item for 24 months into your policy. Now, at the start of year three, which is after that first 2 years, it's fully covered. And if it's something that you told us about, you told us that you had a bad knee, you've always had a bad knee, you've had 3 surgeries on the bad knee, we know about the bad knee, that 24-month thing doesn't impact your policy whatsoever. It's just to protect Manulife because we don't ask disability questions. We're not asking all of those questions. So if you don't tell us about it, we don't know about it, we are going to protect ourselves that way. We also do have a little bit of a limitation for certain conditions that, so that's back, oh, sorry, let me try that again. That's back, neck, and spine. That has a maximum of a 2-year payout. It's still totally payable, but it's just a maximum of 2 years. The same thing with mental health conditions. So depression, anxiety, anything in the mental health realm has a maximum 2-year payout, unless if the mental health issue is related to a critical illness claim, which sometimes happens at the same time, right? Where you're dealing with a major critical illness diagnosis, and it can be anxiety or depression that goes along with that. If that depression or anxiety, the mental health issue is related to a critical illness, then that 2-year limitation evaporates. But that is something for a client certainly to be aware of.
And otherwise, the benefit period is all the way to age 65?
It is to 65. So if you started a claim, just because of the math of it, the 0.5, that turns out to be 16.6 years of payments before that overall pool would be paid out. And again, remembering that it is a pool or a bank account. So as you have a critical illness policy payout, the pool is reduced a little bit. So that would affect potentially a disability claim because you've already taken some money out of the bank account.
Right. And that's an important note. So if you were to have a critical illness, say 4 years into buying this policy, 25% of the policy gets paid out, which means 75% remains for either your death benefit or a disability. What about if you were to have a second critical illness claim?
Absolutely. So a second critical illness claim, you can really, if it was an early intervention benefit, you can have multiple. For the critical illness policy itself, that's only one of the major conditions. But you did hit on something that I typically suggest. So because when we went back and we looked at the risks of a critical illness or a disability happening between now and 65 for most of our clients, that's a higher probability than that of death. However, we know that life insurance and final needs are important. So what I suggest with Synergy is you look at Synergy as your disability and your critical illness account. And then on the side, on a rider, you put your life insurance number that you need for final needs. Because again, there's such a high probability that that pool will be slightly reduced during your working career that you don't necessarily want someone who's gone through some health issues, right? Whether it's disabilities or critical illness, that all of a sudden their life insurance is eroding at the same time because they've been dealing with health issues. So I like to have, like on the side or on a separate policy, I'd like to have final needs coverage as well, just again to ensure that we're not shorting someone on the life insurance risk side.
Yeah, and I would imagine not just final expense needs. Most consumers need more than $500,000, especially if they live in major urban centers. They're probably going to need more than $500,000 of life insurance to cover their mortgage replacement need, their income replacement need, education funding, any other bequests that they have in addition to final expenses. So what insurance options can you add to Synergy as riders?
So as riders, you can do term 10 life insurance, and you can do up to $2 million on the side of Synergy. Also, one of the things, because Synergy actually doesn't have a policy fee, so if your client elects to have another life insurance solution, they're not sort of doubling up on policy fees, which again, we heard the clients didn't like. And also when we talk about, you can add child life rider on the side, and you can also do child CI rider as well. So if you want to protect your children who are under 18, who are still in the house, then we can also insure them as well.
So, well, Vanessa, listen, I really can't thank you enough for your time, your expertise. It's great to have somebody, especially who specializes in living benefits, helping to engage our advisors and talk about this. I mean, the reason we're doing this and inviting our wholesaler partners to join us is to make sure that our agents have the motivation, first of all, to start these conversations, especially as it pertains to living benefits, because I don't think we're talking enough about living benefits. It's more complicated. The claims process is typically more complicated, which sometimes is a deterrent for agents, advisors to want to talk about it. But the purpose of this session is not only to educate our agents on the products that are available, but to share with them ideas on how they can open up the conversation, what markets, who should they be talking to, get some great scripting, some great lines like, what would you tell your younger self? I love that one. And hopefully, well, actually, I know for a fact that's what we've been able to deliver today. I cannot thank you enough for your time today. Is there anything you wanted to say to wrap up or before we wrap up?
Just that it's my pleasure to be a part of these podcasts. And the other thing is, you never have to do this stuff on your own, whether it is your team at Experior, whether it is Manulife wholesalers, we have them across Canada. You can always reach out and ask product questions, but also ask some of those solutions of, well, how do I have this conversation? Or I had this conversation and it didn't go as well as I thought. We can help tweak that conversation and give you some suggestions too. We're
Absolutely,
here to be your
yes.
partner.
Absolutely. And we appreciate that very much. We're very proud to be partnered with Manulife Financial, Canada's largest financial institution. Vanessa, again, thank you so much for your time. We really appreciate it, and we look forward to working with you.
My pleasure. Have a great day.
Thanks for watching Xcelerate. I have another great video right here, so check it out. And remember, Experior Financial Group is about real people, real ownership, and real change. Let us help you accelerate your growth.